Hey guys, welcome back. In today's video, we are talking about the real price of AMC, how the squeeze is happening as we speak, the shorts forced to cover, and many more in this video. Now, first we're taking a look at this. Some of you may be aware that today on some platforms, it showed that Cinemark was down 59% pre-market hours. You can see the price of Cinemark was trading at $15.19 before the market was opened. Now, shortly after, this was then reversed as the market started. We saw where Cinemark went to. Now, the interesting thing about this is why it happened. Now, the reason why I say this is because we have seen cases like this before happen in the past to AMC as well. Now, the difference is that it was the opposite in the sense that we've seen how AMC's share prices has been traded way above its market price, whether it's pre-hours or whether it's after hours. And the reason why we use this, the reason why this is something to be looked at is because of the dark pool orders. And we talked about how they buy shares in areas where it doesn't affect the price. We've seen this with dark pools, we've seen this with OTC trades. And so it looks like that the real price for Cinemark may be that it's only $15.19, or at least this is what the institutions are trading for. And this is important, is because a lot of us may be frustrated watching other theater stocks run while AMC gets suppressed day after day. But let's be honest, AMC is not going bankrupt and the balance sheet keeps getting stronger. That's exactly why I think shorts are in a tougher position than people want to admit. So this is important. It's because one of the things we always talk about as well is the comparison between the Cinemark and AMC. The comparison being that despite the fact we're in the same industry, despite the fact we're benefiting from the same thing, despite the fact that AMC is breaking records, Cinemark tends to go up and AMC goes down, even though we are seeing the same thing. Now, it is frustrating, but it goes down to that core of how AMC is retail owned and Cinemark is institutional owned. And they have been trying for the longest time to get retail to get away from AMC, to sell the AMC shares. Now, going back to what we said at the start and why this is relevant is because they want to show this image of Cinemark being traded at $37. Cinemark consistently going up where AMC is going down. And then when you take a look at AMC, we're seeing red days after red days. We're seeing AMC at 240. But the key factor here is the real price. It's the price in which institutions are trading with other institutions. And we've seen this in data before where AMC shares has been traded at 10 times the market price, 50 times the market price, 100 times the market price. But it doesn't affect the market. It's through OTC trade from one institution to another. We've seen it on data. It just hasn't impacted the price. And so the same thing applies for Cinemark as well. The real value of Cinemark is that of $15, but they want to create this image of $37. And today was just a mix up in the system where they showed the true price. And this is why whilst it's frustrating to see Cinemark go up and AMC go down, it doesn't hide away from the fact that AMC is something that is worth more. AMC has bigger market share. AMC has more potential, and that's something that we have always seen. You can see the largest movie theater is down 14% in the past week, and what we are seeing is the box office having the strongest week ever, with IMAX and Cinemark both up. It clearly doesn't make sense, but it just goes back to what we were saying with how institutions have been trying to create this image, this stigma of AMC being the one that shouldn't be invested within the industry and that people should put their attention towards Cinemark and IMAX. And we've already talked about the biggest reasons for why this is. It's because they're stuck with AMC shorts. It's because they need to buy up all the shares from the retail or they will forever be stuck in this. And it's why we see AMC go down despite all of the good news whilst IMAX and Cinemark is going up. And today, the fact that we saw this with Cinemark and the price, the true price of it reflecting, I think it's proved a lot of what has been happening within the industries. You can see here again where in terms of if you take a look at what's happening within the industry, Spider-Man Brand New Day is tracking to earn $2.5 billion, the third highest grossing movie ever. So if you think about how well Spider-Man Brand New Day has done, think about how well Avengers Doomsday will do. And like we said, it doesn't mean that there's not going to be any other good movies released between this time, but we definitely know for sure that in Q4, we're going to be looking at another great movie. We're going to be looking at AMC breaking records once again. We're going to be seeing AMC making record revenue once again. And these are all things that are not yet being reflected, or at least the institutions don't want to put any focus and highlight towards. And when we take a look at how well AMC has been doing, it's up 160% since March, which all things considered must have been the turning point for AMC, because we clearly saw how well we have done. We've seen how well the box office is, we've seen how efficient AMC is. And there's a reason for why institutions have been trying to accumulate and buy and buy and buy. It's because they've realized that no one is going to wait on them. It's because they've realized that AMC is starting to slowly reflect where it should be. The earnings, the fundamentals, the sentimentals, the FOMO, the APEs, the retail, the institutions, every factor we have talked about in the past are all starting to impact AMC. And now these banks are realizing these hedge funds are realizing it. And that's why they want to try and accumulate as much as possible. And more importantly, they want the retail to be out whilst the institutions get in. And it's why we're seeing that accumulations are going up, but there is still volatility and resistance in the price because they want to try and push the retail out. And remember, if BlackRock wanted AMC bankrupt, it would have kept falling. But they decided to buy AMC because they knew the potential of where AMC is going. They knew what AMC is going to do. They knew the apes in terms of the squeeze. They knew everything that is ongoing with AMC and how well its projection is. And that's why they're buying. They're not going to buy a stock if they think it's going to go bankrupt or it's not going to yield them a return. And so the fact that BlackRock has been buying AMC has been one of the biggest indications in terms of what the actual projections for AMC is. And with the recent extremely good AMC news and future prospect, we can see how confident we are in AMC right now. And it's why we're convinced that AMC is going to see another all-time high, and of course breaking the previous as well, because of everything that it has done, because of the projections, the potential there is for AMC. And that's why we're seeing hedge funds trying to accumulate, why we're seeing hedge funds trying to force retail to sell. And ultimately, the ones who want AMC out of business are hedge funds and short. And we've made this correlation before. We've made this kind of link before in the past. When you take a look at the media articles that are consistently talking about bankruptcy possibility of AMC, that are consistently talking about how AMC should never be bought, how you should sell AMC, you can always make a link between them and another hedge fund. And it makes sense because hedge funds use these media articles to try and persuade investors to go along with them, to benefit from themselves. And this is how we know that when we take a look at if whether or not the shorts and hedge funds are still stuck, you take a look at the media articles, you take a look at who's talking about AMC the most, you take a look at the link they have between other hedge funds, and you get to understand what's going on. And when we take a look at who wants AMC in business, and in terms of why we've said there's been so much of an interest alignment for AMC, is because there are so many companies out there. Whether you're looking at Apple, Amazon, Netflix, like we talked about with the collaboration, whether you're taking a look at Paramount and along with the acquisition of Warner Bros, these are all companies that want AMC to generate revenue because they profit along with that and they have big money tied up with that. And so once again, if you ask me where I think the future of AMC is, I will always say this. There is so much potential because the partnerships, because of the projections, because of how many business actually want to partner with AMC, and we have already seen this. And what we're witnessing, I believe, is a true MOAS happening as we speak. Now, the reason why we're seeing things like this is because we have to understand what AMC has done, where AMC is going, and how the shorts are struggling to keep up. Like we've already said, AMC pushing back their debt, AMC having the ability to pay back their debt, AMC then having the ability to issue dividends, to buy back shares. These are all things that will accelerate and contribute towards the squeeze. Then when you take a look at the short side, the hedge fund side, who are all struggling, whether it's with the swaps, whether it's with the Japanese yen carry trades, whether it's with the bonds, whether it's with commercial real estate. All of these things are all affecting the short collaterals and the margin, and it's why we're seeing them struggle. So behind the scenes, and just like today, as we see with the Cinemark mess up, there is very likely the squeeze that's happening. They're just trying to tune it down. They're trying to suppress it for the time being because they don't want everyone to latch onto this, because they know what will happen the moment they let that pressure out the floodgate. And this is why it's a big thing. And we can also see here from this error mess up as well, where we saw this in the dark pool, where it showed that it was saying AMC volume December 31st, 1969. Now, this was on August 7th, 2026. Now, the reason why this is important is because every time you see this 1969 timestamp, it's because there's an error in the system. Now, it's quite interesting why there's an error. It's because what's actually ongoing within the institutions. And you can see here, on the day the 1969 timestamp appeared, the short-selling clients of primary dealers started unwinding AMC-related swaps while simultaneously shorting US Treasury futures to hedge. Once the pressure was lifted, the stock price had room to rise, and institutions followed by buying in. The 1969 represents too many contracts in a broker's clearing process, leading to errors during clearing, forcing market makers to modify the timestamp in an attempt to delay or control the timing of forced liquidation. So this is the main part that you need to look at in terms of what was happening. They were trying to unwind AMC-related stops. Now, why would they do this? Well, like we've said with the Japanese yen carry trade, this is heavily affecting the margin, which is in terms affecting the swap positions, and their swap baskets can't be kept to neutral. So they have to unload certain positions, hence why we see the unwind of AMC related swaps. More importantly is the fact that they weren't then able to clear up all of these things. It's why we've seen recently in terms of the NSCC saying that brokers are no longer being backed in terms of processing the GME warrants. It's why we see that ETFs above $15 billion will need to wait for approval first before it gets cleared. So you start to see how AMC is slowly breaking up the systems. It's not directly affecting on things that is to do with AMC, but it's affecting in different areas which has links towards AMC, whether it's with the GME warrants that aren't being cleared by brokers, whether it's with the ETFs that needs to be waited for approval. These are all things that are very likely to being affected because of the unwinding of AMC swaps. And then you can see one of the most important things as well, to control the timing of forced liquidations. We may not know this, we may not see this, but it's very likely a lot of institutions have been affected by AMC to the point where they're getting liquidated. And it's why I've said earlier, a squeeze happening as we speak, because a lot of things happening behind the scenes that we don't get first-hand data to, but it's definitely already and still having the effect on the market. And all of this was shown to us. When we see these errors within certain areas, when we see the 1969 timestamp, the due diligence done by the apes, it's exactly what shorts are afraid of. They know that we are slowly catching on to what they're doing. We are able to expose them of the corruption, of the manipulation and suppression. And more importantly, we're able to catch when they're messing up. And so what we really are seeing right now is just the struggle from the short sellers. And if you take a look at AMC from this aspect as well, where they're recently trying to pinpoint in terms of the dilution, in terms of another offering, what we're seeing is right now, no new common shares authorization being requested. But there is a 25 million raise to the employee equity plan, but that's not a new ATM or capital raise authorization. Now, the reason why I said that they're trying to pinpoint this is because there's always a negative agenda with AMC dilution. And this is something that we've already talked about before. Yes, it has negative impact, but the positive outweighs the negatives, whether it's the short term or long term, at least in my opinion. Now, with this, we have to understand that this is only a 25 million increase towards the existing shares, a very small percentage, but also it's towards employees. It's an equity plan which will very likely and at least hopefully encourage the incentive for employees to work even harder. And this is ultimately what we want to see. If we are able to see employees work harder, if we're able to see these managers, kind of the executives, to all start working harder for the benefit of AMC, because there is more interest, financial interest tied up with them, then that we're still going to be benefiting from this, because we are still going to be seeing AMC going up. And so it's not something where I think it's as massive as what we've seen in the past before, but the fact that media articles are trying to really highlight this and make it seem like it's the worst thing ever, I think that's something that needs to be understood as the fact that it's just another tactic used to try and scare the retail. As always, known as financial advice, and I'll catch you guys next time.